Have you ever wondered how the Federal Reserve and their policies impact your daily life, from your mortgage rates to the price of groceries? In just a few minutes, I'll break down who they are, why they were created, and how their decisions actually shape our economy. Stay tuned to learn more about the Federal Reserve and what are their actual powers. To understand the Federal Reserve, we need to go back to the early 20th century, think like early 1900s. Picture this. The U.S. economy is very much like a roller coaster ride, but not the fun kind at all. It was growing rapidly, but it also experienced frequent financial panics and bank runs. One of the most severe was the Panic of 1907, where lack of liquidity led to widespread bank failures and economic turmoil. But wait, what's a bank run? Imagine playing a game of musical chairs, but with your money. And when the music stops, there's no chair and there's no money. So you can't go to the bank and take it out. A bank run happens when a large number of people all at once lose confidence in their bank's ability to return their deposits. They rush to withdraw their money, fearing the bank will run out of cash. And since banks don't keep all the depositors' money on hand, they lend most of it out, they can't give everyone their money back at once. This causes banks to fail and potential panic to spread, not just to that bank, but also to others that are just like them. It's very much like a domino effect, but with your life savings on the line.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
So what exactly is the Federal Reserve? Often referred to as the Fed, it's the Central Bank of the United States, which was created in 1913 when President Woodrow Wilson signed the Federal Reserve Act into law. It consists of a board of governors in Washington, D.C., and 12 regional Federal Reserve banks located in major cities across the country. Each of these regional banks serves a specific area, providing a decentralized structure that helps cater to the diverse economic needs of different parts of the country. The Fed is unique as it was really created to be an independent entity within the government, meaning it would operate without direct interference from political bodies, allowing for more objective and stable economic policies. Although the Fed's political independence has been in question on many occasions by the media and also the general public, and I think that will continue. The Federal Reserve has what's known as a dual mandate. This means it has two primary objectives: promoting maximum employment and ensuring stable prices. Let's break both these down. First, promoting maximum employment means the Fed aims to create conditions where as many people as possible who want jobs can actually find them. This doesn't mean zero unemployment, as there will always be some natural level of unemployment from people transitioning between jobs or moving to different geographic regions across the country. It means keeping unemployment low and stable. The second is ensuring stable prices, which basically means managing inflation. Inflation is the rate at which general level of prices for goods and services rises and subsequently consumers' purchasing power falls, which means that the money that you have to buy a good now will be worth less in the future. The Fed has a target rate of 2% inflation over the long term, what they consider to be consistent with their mandate for price stability and moderate long-term interest rates or growth. One of the main tools the Fed uses to achieve its dual mandate is setting interest rates, specifically the federal funds rate. This is the interest rate at which banks lend to each other overnight. We'll talk more about this in a second. So how does the Fed actually set interest rates? This process is conducted by the Federal Open Market Committee, or FOMC, which meets 8 times a year, and the FOMC consists of 7 members of the Board of Governors and 5 of the 12 regional banks' presidents. They analyze economic indicators such as GDP growth, unemployment rates, inflation, and just global economic trends to make their decision. Based on their analysis, the FOMC can choose to raise, lower, or maintain the federal funds rate. Raising the rate typically aims to cool off an overheating economy and curbing inflation, while lowering the rate aims to stimulate borrowing, spending, and economic investment to boost the economy. So the federal fund rate influences other interest rates, including those for mortgages, car loans, and business investment. So the Fed gives banks the interest rate at which they can borrow, which is what is called their borrowing costs. So in order for the bank to make a profit, they need to add on a premium to that rate, which is the interest rates that they charge consumers for credit products such as mortgages, auto loans, credit cards, those sort of things that we use every day. If the rate increases, banks face higher borrowing costs, which they often pass on to consumers by raising their interest rates. And on the other side, when the federal funds rate decreases, borrowing costs for banks are lower and they reduce the rates that they charge consumers. Interest rates play a crucial role in the economy because they influence borrowing costs and the overall level of economic activity. And here's why they matter. First is consumer spending. Lower interest rates makes borrowing cheaper, encouraging people to take out loans for big ticket items like homes and cars. This boost in consumer spending is really what drives growth in the economy. Second is business investment. When interest rates are low, businesses find it cheaper to finance expansion projects, purchase new equipment, or hire new employees. This investment leads to job creation and productivity improvements, which again helps drive the economy. Third is inflation control. By adjusting interest rates, the Fed can influence inflation. Higher rates tend to reduce spending and borrowing, which can help cool off an economy that's growing too quickly and prevent runaway inflation, which we all know is very bad. Lastly, exchange rates. Interest rates can also impact the value of the US dollar. Higher rates typically attract foreign investors looking for better returns on their investments, leading to a stronger dollar. On the other side of that, lower rates can weaken the dollar but boost exports by making US goods cheaper for foreign buyers to purchase. So let's recap. The Federal Reserve is a central bank of the United States created to provide financial stability and monetary policy. Its dual mandate is to promote maximum employment and ensure stable prices. The Fed sets interest rates through the FOMC, including borrowing costs and economic activity. Interest rates are vital for managing consumer spending, business investment, inflation, and exchange rates. I hope this video has given you a clear understanding of the Federal Reserve, its role in the economy, and the importance of interest rates. If you found this information helpful, don't forget to like and subscribe so you never miss an update from the Owners Club. Thanks for watching and take ownership of your financial future. And if you have any questions or topics you'd like to cover in future videos, leave a comment below and see you next time.